Imagine I hand you £100,000, and would you risk it all on one sure thing? Then tempting, but dangerous. Well, for every overnight success story, there are thousands who lose everything betting on a single outcome. Investing always involves risk. The higher the potential reward, the higher the risk. The real secret isn't avoiding risk, but managing it smartly. That's where diversification comes in. Don't put all your eggs in one basket. Spread your money across different investments to protect yourself from disaster. It's not about getting rich quick. It's about not getting poor quick. Don't put all your eggs in one basket is the golden rule of investing. If you invest everything in one company, like Blockbuster, you risk losing it all if things go wrong. But if you spread your money across different companies, industries and assets, one failure won't wipe you out. Diversification cushions the blow of losses and smooths out your investment journey. You might not hit the jackpot, but you'll avoid devastating crashes. It's about building a financial safety net that grows steadily. That's the grown-up way to invest. When you think about investing, you might wonder, what does a good diversified portfolio actually look like? The answer isn't one size fits all. In fact, the best portfolio is as unique as you are. It all depends on your personal situation, your age, your financial goals, and how much risk you're comfortable taking. These factors shape the way your investments should be structured. For example, if you're young like Sarah, you have time on your side. You can afford to take more risks, investing a larger portion in stocks, which can offer higher growth over the long run, even if they're a bit more volatile in the short term. On the other hand, if you're retired, like David, your focus shifts. You want to protect what you've built, so you'll likely want more stability, allocating more to bonds and other lower risk investments to help preserve your wealth and provide steady income. The perfect mix of investments balances your need for growth with your comfort level for risk. It's about finding that sweet spot where you can sleep well at night, knowing your money is working for you, but not keeping you up with worry. This is the heart of modern portfolio theory, combining different types of assets like stocks, bonds, and real estate to get the best possible return for the amount of risk you're willing to take. Diversification helps smooth out the bumps along the way. Remember, it's not about trying to pick the next big winner or timing the market perfectly. It's about building a portfolio that's tailored to your unique needs, preference and life circumstances. Your portfolio should fit your life, not someone else's. Make it personal, make it yours, and let your investments reflect who you are and where you want to go. The stock picking genius is mostly a myth. Even professional fund managers rarely beat the market over time. If the experts can't do it, why should we expect to? Luck, not skill, explains most big wins. Instead of hunting for the next Amazon, buy the whole market with a low-cost index fund. You'll get the market's average return, steady, reliable growth that builds real wealth. Don't try to beat the market, join it. When it comes to understanding risk in the world of investing, professionals don't just rely on gut feelings or hunches. Instead, they turn to sophisticated tools like the capital asset pricing model, better known as CAPM. This model is a cornerstone of modern finance, helping investors connect the dots between the risk they take and the returns they expect to earn. CAPM provides a structured way to think about how much extra return you should demand for taking on additional risk, making it a go-to framework for big institutional investors and analysts alike. At the heart of CAPM is a simple but powerful idea. If you want to earn more, you have to be willing to take on more risk, but not all risk is created equal. CAPM measures risk using something called beta. Beta tells you how much a stock's price moves in relation to the overall market. If a stock has a beta of 1, it moves in sync with the market. If it's higher than 1, it's more volatile. If it's lower, it's more stable. For example, blue chip companies, think established giants, usually have low beta values, meaning their prices don't swing wildly. On the other hand, fast-growing tech startups often have high betas, reflecting their unpredictable ups and downs. Investors use beta to decide how much risk they're comfortable with and to build portfolios that match their goals. But here's the catch. The market only rewards you for taking on risks that you can't avoid, broad market-wide risks that affect everyone. If you're just betting on a single company, you're taking on extra risk that the market won't pay you for. That's why professionals focus on diversifying their investments across many companies and industries. Models like CAPM aren't perfect. They can't predict every twist and turn in the market, but they do reinforce a crucial lesson. Spreading your investments out or diversifying is the best way to avoid unnecessary risk and protect your portfolio from unexpected shocks. No one can see every crisis coming, whether it's a sudden market crash or a global event. But by understanding how risk works and preparing in advance, you can weather the storms and stay on track toward your financial goals. Remember, risk and reward are always linked. The more risk you take, the greater your potential reward, but also the bigger your potential loss. It's all about finding the right balance for you. So as you build your investment strategy, be smart and intentional about which risk you choose to take. The best investors aren't the ones who avoid risk altogether. They're the ones who understand it, manage it, and use it to their advantage. So what's the plan? First, diversify. Spread your money across different assets, industries and regions. Use low-cost funds to make this easy. Second, rebalance once a year. Sell a bit of what's grown too much, buy what's lagged, and keep your risk in check. A third, stay calm and think long-term. Markets will rise and fall, but diversified investors recover and grow. Don't panic during downturns. Stick to your plan. Diversification is about control, discipline, and steady growth. Review your portfolio, stay focused on your goals, and let time do the work. That's how you build real wealth and peace of mind.